Welcome to a presentation in Fundamentals of Accounting. I am Berman Kauseni. Hope you are going to enjoy this presentation. Well, our focus of attention will basically relate to adjustments to final accounts. Now, it is very important to understand what final accounts basically relates to. So when we talk about final accounts, it is important for us to acknowledge that it basically relates to the income statement, which can also be referred to as a statement of profit and loss, and of course, the statement of financial position, which is traditionally referred to as balance sheet. Now, it is also important from the outset for us to appreciate that adjustments in final accounts are extremely vital in order to ensure that all revenues and expenses are recorded in the correct accounting period. Well, so it is important that we acknowledge the fact that in line with the accrual basis of accounting and international financial reporting standards, it is important that we provide for adjustments in the final accounts. Now, what are the common adjustments in final accounts? There are a number of such adjustments, and in this regard, we are going to look at these common adjustments one after another so that we appreciate them at the end of the day. So now, what is the first adjustment which we are going to look at? We are going to look at accruals. Accruals are also referred to as outstanding expenses. Of course, we appreciate the fact that expenses basically relate to the day-to-day running costs of the business. So now, what is the definition of accruals? How can we define accruals? Well, accruals are basically expenses which are incurred during the accounting period but are not yet paid by by the end of the year. In other words, they have not been paid for by the time of the end of the accounting period. Well, having had appreciated the definition for accruals, let us try to look at how we can adjust for these um, expenses in the final accounts. So, adjustments to be made in relation to to accruals is that we have to deal with it in one, the income statement, and secondly, we also have to deal with it in the statement of financial position. So, in the income statement, an expense which has accrued is supposed to be added to the relevant expense account. That is in the income statement, and specifically in the profit and loss account. And then in the statement of financial position, we need to record the accrual as a current liability. We have to record it, or we have to list it under the current liabilities. Current liabilities being those financial obligations which the business has to meet within a space not exceeding 12 months. We continue with accruals. And in this particular instance, let us try to look at an example. Let us assume that rent was due but unpaid at the year end. What would be the journal entry for such a transaction? Remember, based on the principle of double entry, every transaction needs to be recorded twice. The recording of a transaction based on the principle of double entry is twofold, meaning that we need to make a debit entry in one account and a corresponding credit entry in another account. So in this regard, when we look at a situation where rent is due but has not been paid by the end of the accounting period, the two accounts which we need to identify are one, the rent expense account, and secondly, the accrued expense account. Therefore, the rent expense account contained in the income statement and specifically in the profit and loss account will be debited. And the corresponding entry, of course, will be a credit entry in the accrued expense account. Well, having looked at accrued expenses, let us move on and look at prepayments. Prepayments, which can also be referred to as prepaid expenses. Now, what is the definition of prepayments? What are prepaid expenses? Prepaid expenses are those expenses which are paid in advance for a future accounting period. Now, if that is the case, it is important that we look at the manner in which such expenses can be adjusted for. So, the adjustment is basically twofold. In the income statement, specifically the profit and loss account section, and secondly, the adjustment will be in the statement of financial position. So in the income statement, the prepayment is supposed to be deducted from the relevant expense account. We need to subtract prepaid expenses in the sense that they do not relate to a particular accounting period we are looking at. So that is the adjustment in the income statement. And then the adjustment in the statement of financial position would require us to record it as a current asset. In other words, we need to list it under the current assets in the statement of financial position. Okay, so at this particular moment, we'll proceed and look at an example relating to how a prepayment can be dealt with. So in this regard, we are looking at insurance paid for next year. So in this regard, what would be the journal entry? As usual, any transaction based on the principle of double entry requires two accounts to be dealt with. One account is supposed to be debited, and it should have a corresponding credit entry in another account. So in this particular instance, where we need to record an expense item paid in advance, and in this regard, we are looking at insurance, the journal entry would be that we are going to debit the prepaid expense account, which is an asset to the business in this regard. And in this particular instance, we are crediting the insurance account or the insurance expense account. And of course, the corresponding credit entry will be, I was saying that the journal entry will be that we need to debit the prepaid expense account. The prepaid expense account, which in this regard is an asset on the part of the business, and then the corresponding credit entry will be made in the insurance expense account. This is in the income statement, particularly the profit and loss account. Okay, let us make progress. In this particular instance, we are going to move on and look at depreciation of non-current assets. Depreciation of non-current assets. Now, the first thing we are going to do in this regard is that we are going to look at the definition of what we're trying to look at. So, when we talk about depreciation of non-current assets, the definition which can be attached to it is that this is essentially the allocation of the cost of a fixed asset over its useful life. We can define depreciation as essentially being the allocation of the cost of a fixed asset or non-current asset over its useful life. Now, there are a number of methods which we need to focus our attention on with regards to providing for depreciation. Now, what are these methods? We have the straight line method and the reducing balance method. So how do we deal with the straight line method? The straight line method basically requires us to ascertain the cost of the non-current asset and then take into account the residual value, which can also be referred to as the scrap value, divided by the useful life of that particular non-current asset. So in essence, what we're saying here is that the formula which we need to use for the straight line method is cost minus residual value or scrap value divided by the useful economic life of that particular non-current asset. And then we can move on and look at the reducing balance method. So under the reducing balance method, we are required to apply a fixed percentage to the asset's book value. So now the question is, how can we adjust for this expense item? In this regard, we are looking at depreciation. So the adjustment will be twofold. One, in the income statement, and secondly, in the statement of financial position. So in the income statement, particularly in the profit and loss account section, the depreciation charge will be treated as an expense. It will be treated as an expense. And then in the statement of financial position, the depreciation charge will be deducted from the assets carrying amount. We continue with depreciation methods. Now, in this particular instance, our focus will be to look at the journal entry using the straight line method. If we are using the straight line method, the journal entry will be debit depreciation expense account in the income statement, and we credit the accumulated depreciation account. In this regard, remember, in place of accumulated, we can also have words such as provision for depreciation, or we can have words such as allowance for depreciation. Well, so at this particular instance, this being the first session in relation to adjustments to final accounts, we shall safely say that we have come to the conclusion of our presentation, and it will be important for us to acknowledge that when we are looking at adjustments in final accounts, we should appreciate that adjustments are essential, basically in order to ensure that financial statements comply with the International Financial Reporting Standards and the accrual basis of accounting. Now, these adjustments will aid in the presentation of a true and fair value of the financial position and performance of an entity. So at this particular instance, I would safely say that we have come to the end of this presentation, and the preceding the subsequent presentation will focus on now looking at practical examples of what we have discussed in this presentation. For now, I'll safely say cheerio.